Welcome back to John Orfer's Note. A lot's been done to heal the wounds in the eurozone in the past year or so, not least because of action by the European Central Bank. But big divergences remain in the interest rates paid by small businesses, which is raising worries about whether countries such as Spain and Italy will be able to pull themselves out of the deep recessions. With me to discuss what's been going on in small business lending markets is Huw Pill, who's the chief European economist at Goldman Sachs. Huw, our first chart is quite dramatic picture showing the divergence we still have in interest rates between Spain, Italy down in the south, and Germany and France up north. Tell me, what's caused this big division?
Well, I mean, I think there are two, possible explanations of why, despite the fact we've seen more integration, if you like, in the sovereign markets and so forth, that we're still seeing this big divergence in the lending rates that banks are charging, in this case to small businesses. One possible explanation is, which has some validity, that the economic situation in Spain and Italy is just much worse.
The credit risk.
The credit risk that companies are taking in those countries is greater. We think, though, that although that's part of the story, a certainly important part of the story in parallel with that is that there remains a segmentation of financial markets, and banks in the peripheral countries are unwilling or unable to be able to make rates at the same...
Unable to because of the regulators?
Well, I think that probably plays into it. I think they probably have a harder time raising funds. I think they probably have a weaker capital position. And I think because of the quality of the borrowers they're facing, they probably have more risk aversion in their environment.
You mentioned that actually we've had some progress in repairing sovereign government debt markets. The spreads between Spain, Italy and Germany have reduced. In fact, if we pull up our second chart, you can see that quite clearly on the blue line. But what you've plotted against that is a red line. It says Goldman Sachs interest rate divergence indicator. Tell us what that showed, because that's still very high.
Well, yeah, what the previous chart showed was bank lending rates in quite a narrow bucket of loans, where we've chosen a kind of comparable narrow bucket, so we compare across countries.
What businesses are actually using.
Right. But I think the problem with that is, of course, that's not probably in all cases very representative of all the loans that are taking place. So what we've done is sort of pooled all the information we have on interest rates in different countries and constructed this indicator of the divergence between bank lending rates in the core countries and bank lending rates in the periphery. And the crucial point you're making is, in the middle of last year, Mr. Draghi made his famous intervention to do whatever it takes to support the euro and to remove the convertibility risk and reintegrate markets, etc. And that's led to quite a sharp narrowing in sovereign spreads. Here capturing the spread on 10-year bond yields in Spain and Italy versus that in Germany. But what we find is, although his efforts have halted the increase in the spread of rates between bank lending between the core and the periphery, it hasn't yet brought it down.
In fact, it's the highest it's ever been.
More or less,
Okay, what can the ECB do about this? Is there steps it can make?
Well, I think, the first thing to say is that what we've seen here is that this rate hasn't come down despite the fact that the spread hasn't come down, despite the fact that the ECB cut rates, despite the fact that the ECB has done LTROs. So, we think that in order for the ECB to try and offset the impact of this widening spreads, it needs to act more directly in those markets that have problems. In other words, this is a reflection of the segmentation and fragmentation of banking markets in Europe. And in order to deal with the consequences of that, you need to go to those sectors which are most problematic, say loans in the periphery to small and medium-sized enterprises, and act in a more proactive way.
All right. The big question, of course, is how worried we should be about this. If we look at the final chart, which is the PMI showing activity, we have the eurozone periphery still deep in recession, dipping down, if anything, towards the end there. Do you think the ECB, I mean, you used to work there, do you think they're looking at the sorts of things you've been looking at and drawing up plans as we speak?
I mean, I think the ECB is very concerned about the ability of banks to lend to small enterprises in the periphery, because I think, like us, they attribute a big part of the weakness we see in the periphery and the divergence in growth between core and periphery to the fact that these small and medium-sized enterprises that are both the dominant part of the corporate landscape in Spain and Italy and other main sources of growth.
Job creation, they need to do something about this.
So yes, I mean, I think as Mr. Draghi made clear in his last press conference, the ability ability for the ECB itself and alone to act in that direction is pretty circumscribed. So the question is, can he mobilize the national central banks, the governments, to act in concert with him to address this problem?
Huw, thank you ever so much. So food for thought there for the European Central Bank and Mario Draghi. A lot of work though to do to help the small businesses in the eurozone's periphery.